When you hear Warren Buffett, you probably picture the Oracle of Omaha, right? Someone who makes investing look, I don't know, almost effortless.
Mm,
But what if that early path wasn't quite so simple? What if it involved uh, really intense work, even some surprises?
that's exactly it. And that's what we're digging into today. We're looking at Brett Gardner's Buffett's Early Investments.
Hmm.
This book really dives into those decades where Buffett got those, legendary 29.5% annual returns.
Wow, yeah, compared to what, like 7.4% for the Dow?
Exactly. A huge difference. And the book shows it wasn't just luck or one simple trick. It was intense research, sometimes into pretty non-obvious situations.
Okay, so let's trace that. How did he start building that playbook? Maybe start with Union Street Railway in 1954. That sounds like a classic early Buffett move, the net-net.
It was a classic net-net. The basic idea is simple. Buy a company for less than its working capital. Essentially, it's net cash after subtracting all liabilities.
Like getting a dollar for 50 cents?
Pretty much. So Union Street Railway, this bus company, he bought shares around $35. But the company, even though it was losing money operationally, had something like $60 per share just sitting there in treasury bonds and cash.
Okay, so statistically cheap. But there's more to it, isn't there? He didn't just buy the stock.
No, and this is key. He actually traveled out there, met the company president, Mark
I
Duff.
physically went there.
Yeah, did the legwork. And, well, shortly after that visit, the company pays out this huge $50 per share dividend.
$50 on a $35 stock.
Exactly. So it wasn't just finding a bargain bin stock. It shows him influencing capital allocation, pushing to unlock that value.
Right, so even early on, it wasn't passive. Sometimes it needed a nudge.
It really highlights that sometimes you need that catalyst, maybe even getting involved, to get the returns out of, well, frankly, often mediocre businesses back then.
That's fascinating. Okay, so he's learning to unlock value in tangible assets. How did that thinking evolve when faced with something more intangible, like trust? I'm thinking of the American Express crisis.
Ugh, a salad oil scandal in '64. Yeah, that was a big one. A real test. You had this company, Allied Crude Vegetable Oil Refining, basically swindle American Express. Amex was on the hook for, what, $175 million in missing oil?
And their entire equity was way less than that, right? Like
Yeah.
$78 million.
Yeah, it was potentially catastrophic. I mean, shareholders could have even faced personal liability. It was that serious.
So total panic situation for most people.
You'd think so. But Buffett, he approached it differently. He actually spent days just observing their offices, watching how people used their services.
Observing, what did he see?
He saw that the core businesses, the travelers' checks, the money orders they ran on absolute trust. People relied on the Amex name completely. He even wrote to the CEO basically saying, look, honor the debts, even from the subsidiary. Protecting the brand, that trust, it's worth far more than this settlement cost. He called the scandal an act of God.
Wow. So he saw the brand itself as the most valuable asset, even when the financials looked terrifying.
Exactly. It was a huge turning point. It showed him the incredible power of a strong business franchise. And, well, that intangible thing called reputation. It wasn't just about the balance sheet anymore.
Okay, so from tangible asset plays influenced by him to recognizing deep intangible value. What about finding quality, maybe hidden within a seemingly risky business like Disney in '66?
Right. Walt Disney Productions. So the stock looked cheap, partly because Mary Poppins had just been this huge hit, artificially boosting profits, maybe?
And the movie business is notoriously volatile.
Totally. Plus, investors were worried there was key man risk, what happens after Walt Disney, and there were even concerns about sort of self-dealing with his personal company, Retlaw.
So legitimate concerns on the surface. What did Buffett see differently?
He looked past the immediate noise. He saw Disneyland, this incredible growing theme park. I mean, the Pirates of the Caribbean ride alone cost $17 million to build.
And the whole company was valued at.
Around $80 million.
That's incredible.
And then there was the film library. Hundreds of films, all those animated classics, just sitting there on the balance sheet, valued at basically zero.
Written down completely.
Yeah, but he realized they could be re-released over and over to new generations. It was this huge hidden asset. He apparently even went to see Mary Poppins himself, like 2 p.m. on a weekday. Joked he almost felt like he had to rent a kid to fit in.
Huh. So he basically got this amazing film studio and a growing theme park almost for free, hidden behind the movie volatility concerns.
Pretty much. It really shows him finding that margin of safety, not just in numbers, but in the quality and hidden potential of the business itself, combining the cheapness with a deep qualitative insight.
So looking back at these early plays, What's the real takeaway for us? It's clearly not just buy cheap stocks.
No, not at all. It's about, well, evolution. He started with statistical bargains, sometimes needing to push management. Then he learned to value intangible strengths like brand trust, even in a crisis. And then finding those truly wonderful businesses where the value was hidden in plain sight. If you look beyond the surface numbers and risks, it was about tenacious, deep research and adapting his approach.
It really underscores that the Oracle wasn't born overnight. It was built through intense work, learning, and broadening that definition of value.
Absolutely. He built his filter, as people call it, through these experiences, successes, and even the near misses or mistakes.
So maybe the challenge for you, the listener, is this. Next time you hear a simple investment rule or mantra, pause and think. Is there a deeper story? What hidden assets, tangible or intangible, might you be overlooking in a situation that seems obvious to everyone else?